All right, so let's talk about trading system. I'll go slide by slide and then I'll answer your questions, okay? So the reason it's so important to have a trading system because you don't have a second thought what to do. Um, Emotions, it's a big play in trading, right? So how to tackle those emotions and get rid of those emotions is to have rules and a system. Like, think about system, it's like an algorithmic approach. If you want to write an algorithm for computer, right, for an automatic trading, so you have to be uh, very detailed, right? You have to write all those specific rules, and that's why you have to think, um, how can you have the most important things in your system and get rid of something that is it's not helping you, right? Irrelevant. All right, so we're gonna talk about foundations a little bit. What's important to analyze when you looking for charts, when you're building your trading system, and we'll go over some playbooks. Um, if you didn't get this presentation, so you can send me your email and I'll send you the link. So for the time frames, so important to understand. We have um, a rule of 3 time frames: weekly, daily, and hourly. Weekly gives you direction. Daily gives you entry. Hourly gives you trade management. Early signals for you to enter. Early signals for you to exit. Smaller time frames, and this is for swing trading, right? Smaller time frames usually gonna give you a noise, but sometimes you get on hourly wide range big candle, right? You can zoom in technically on a smaller time frame, like a 15-minute, and see maybe how does it look inside the 1 hour, right? All right, so here's an example. Here's an example of 4 time frames, how to use it. The direction of Boeing pretty much going nowhere, right? We're consolidating but declining down. On daily, we're declining down. On hourly, looks like they find a little bit of volume and doing a reverse head and shoulders. So this could be played for a smaller time frame, right? But here's a rule of thumb: trade directional on all time frames. If the weekly and daily gives you no, hourly and 15 gives you yes, this is only a short-term play for 1, 2 days, pretty much daily, a day trade, right? All right, so market cycles. I saw a few questions there about market cycles. Let's see. So there are 4 cycles. You got accumulation, uptrend, distribution, downtrend. As a long trader, you only should be focusing trading stage 1 and stage 4 as a long trader, right? Well, it's different in 1 and 4 stage. In stage 1, in stage 2 uptrend, when you enter a trade, I'll show you an example. When we enter a trade, the goal is to build a position and ride the trend, right? When we trade long setups in stage 4, those are different ideas. They have a short life. They 1, 2, 3, 4, 5 days overextended short sell rallies, right? And they're more advanced. Like here, you got a weekly breakout. You could take this as a trade, right? If it give you a signal and play, but you have to understand that you trading in the stage 4 right now, decline. and the bigger time frame gives you no, daily and hourly gives you yes, you only can do this for a small play. Let's look at that 1 hour chart. And this is a big difference, because sometimes when you don't look at the stages, right, and you start thinking like, okay, maybe I'm gonna use the same approach I'm using in stage 2 breakout here, right? I'm gonna use the same, because it looks the same right here. Look at this setup right here, double bottom, right? And then you got this kind of a consolidation and a breakout. And you start thinking about this is the same breakout. It's not the same, because it's in a decline. You can get a move here, but you have to understand it's a 1 or 2 day move, and that's it. All right, so to the question, I see Live Fire asking me about stage. When evaluating what stages the stock is in, do we use the weekly time frame to make the yes, like I said, weekly gives you direction, right? Less noise, direction. Daily gives you that entry, and the smaller time frame gives you precise entry or better management. If you have any questions, you can type them in the trading chat. That's where I'm going to keep it open. So stage 3. You know, there are certain signals in stage 3. How can you determine when we entering into stage 3? So the moves become erratic, right? The moves become wild. We get lots of gaps. Right here, we had a big gap down. Then we had big wide range candles with selling pressure. Then we have snaps back. We have a lot of fake breakouts, and we had a lot of fake breakdowns. This was a fake breakdown below this level. We snapped back. And in stage 3, often you start seeing this first signs of change of character, besides the one I just explained to you, but another character, which is lower highs. As you can see here, it started to build lower highs. Also important to understand, this is a good example with earnings per share. As you can see, earnings per share started to decline. We had an increase right here, a little bit of decline here, more decline here in stage 3. If you go into history, you will find this. It happens again and again that stocks like to move into anticipation of good numbers. When earnings already reported, it's in the past, it's in the rear mirror, right? So the reaction is so important as well, right? Sometimes what institutions like, they like to trade surprises. What if this earnings would be not the 18 cents from 20 cents to 18 cents, but would be like 30 cents and higher guidance? Well, this probably would be a stage 3 and would be another stage 2 continuation. Here's another rule of thumb I use. How many bases do we have here? 1, 2, 3, 4. How many more bases can we get before we're going to do some sort of a pullback? How much this company can grow? There are exceptions. Google, right? You can Google, you can look at Google, you can look at Microsoft, you can look at Apple on a weekly charts. They like exceptions, right? They can build this basis on basis, but very often those bases could be like a year long and keep up trending on a weekly and monthly. But rule of thumb, I use like 3-4 bases, and it's not the best idea to buy breakouts after that, right? So here's some example on C-check. I also mentioned, here's another one, 1, 2, 3 bases, and after that stock is actually going into decline. So there's some entries, examples how to enter, I mentioned here, so you can read. If you have any questions, let me know. I'll go over this a little bit. So this was a great entry on a stage 1. See stage 1, stage 2 breakout, power earnings gap. This was a great entry on a pullback, stage 2 pullback. This was another stage 2 pullback. So it's forming stage 2. Right here we have a range. We had initial move and another pullback to the moving averages. So, and then you get a nice advance and another sell-off after earnings. As you can see, earnings per share dropped and we got into this consolidation. But often they have a really good guidance, and you see these earnings per share were higher. You also have to look at sales. You have to look at guidance. You have to look at what happened, like with their expenses. Or why are they cutting their expenses? Because they cutting on internal business parts, like let's say they closing stores, right? And they're cutting their expenses, which is not good in the long run, but it could be good in the short term, right? If it's a short term good movement, yeah, you can get a burst like this. So, but you really want to see long term big changes. So here was a good example of entry, a little bit of cheat. So I got this question sometimes, okay, why would you enter here if this still has to clear this level, the yellow line, right? Stage 2 continuation breakout. Well, often you can have this cheat kind of entries. And if you're not sure, you can break them down in small portions, right? You don't have to go full size here or full size here. You can test the water. Why this would be a good entry? Because you got double bottom, high and low right here forming, and you got a burst with volume. You see this green bars? Volume. This is unusual big volume. And then price holds moving averages. Then you get moving average cross, and this is called wedge pop. When price pops through the moving averages, you can see it's a little bit of wedge here, and it's doing a pullback to the moving averages. Again, first thing, what's the most important is the price, then volume, then we have the rest, moving averages and stuff like that, all other indicators, right? So the price tells you a story here, and volume tells you a story, right? So the price building high lows here, 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 and then we have wide range bar, big volume surge, coming to this pivot point and pull back under the pivot. Volume and price confirms. So then you put it in context moving averages, and you can play this as a momentum uptrend, right? This is an example. So, and as you can see here, you got this burst, then you got a pullback, stage 2 pullback right here. You could take this entry in this example, 6. This and this breakout, one of the best entries. You got this flat top breakout and pullback. What do you see when we have a pullback? It's so important to understand the volume. You see this yellow 2 bars? This is low volume, unusual low volume on a sell. And then how would you enter here? It's simple. You put an alert. You put an alert at the pivot. Where is the pivot here? This red bar, from this red bar, tiny red bar here, we made a low. Came back on wide range bar, did engulfing price action, pull back inside day, and a breakout. So you play candle over candle, and you get another uptrend. As you can see, it starts getting loose here. And we already know this is a third base. And you know simple rules. If you have simple rules like if price breaking down below 8 or 21, you got to be selling, right? And then you have so much time to understand that the stock, the price is falling off the cliff and changing the direction. It can't break higher. Here's a fake breakout, right? The moving averages start sloping down. The big ones, 50, 200 still pointing higher. Then you get a breakdown below 200. That's it. This stock should be on your radar for stage 2 play. It's only stage 4 short burst, right? And it will be fine. Look at this. This was a great setup right here. You got earnings came out, and note EPS was higher here and it's lower here, right? So double bottom here on a daily, high low, high low. Can you play this? Yes, but you have to understand stage 4. Would it work? Yes, as you can see, it would work, and you would be selling into the resistance. The moving average is your resistance, which is 200. As you can see, it tried to make new high and could not. And the earnings came out, we dropped. And this was a great short. We're not talking about shorting here, only playing on the long side. So I would recommend learn that first before start shorting something. But that was a very good rejection, engulfing price action, and the volume started to increase here. Lower high compared to this. You get a nice drop, stage 4. All right, so question, when you talk about basis, can you cover how we determine if it's a base or what characteristics make up a base? Well, basis, let's go into this, move higher here. So bases, they have highs and lows, right? It's when the price building a channel. So your channel is your base, as you can see. This is the base. So you get high, you get low, you get high, you get low. So important to understand the proper base. What is a proper base? The proper base, stage 1. Let's go to this example. I think Peloton has a good one. Yeah. Let me open my drawing tool. I'll show you something. All right, here you go, stage 1. All right. So this was our high right here. I'm gonna draw for you guys. After earnings. And we can look at the volume too. So after that, the price pulled back, and as you can see, we have in a big volume right here. Big volume right here. So this was engulfing price action. Yes, it popped higher right there and a little bit rejected on that week, right? But this is a change in character because of this big volume at the bottom. Right here. So if you put a trend line from here to here, you see price broke below a key level. Prior consolidation from October, November, and big volume came and we popped back immediately. The next week we pop back immediately, right? Price doesn't want to stay there. There's the first sign of there's no sellers coming, that actually buyers came and supported, and we had a shakedown, fake breakdown below. What do you see after that? Price goes higher for the next few weeks. Volume right here increasing, right? Then you have smaller volume right here, and you get, which is on a red day right here. And what do you see? Those 2 weeks, this is very important. These 2 weeks, they give you an early cheat entry. Those 2 weeks inside, the red week inside of prior white week. So this, I'm gonna remove this. This is gonna be your LPS. This is gonna be your spring. Oops. Spring candle, or you can call it engulfing, fake breakdown. This is going to be LPS, last point of support. This is going to be your another LPS. What is highest point of support? It's the high low, right? The high low. So right here, we're still in stage one, right? Right here would be a great entry. Why? Because you can see moving averages right here, decided to go flat and slightly sloping higher. And this is a weekly chart. Then, you know, earnings coming 3 weeks from now, right? But the play is there. Let's look at this chart right here. Let's look at this chart. All right, so on this chart, as you can see, this was a good entry. And then you gotta move for 3-4 days, right? You got this initial cheat sheet move. But the big play came really with the power earnings gap right here. So back to your question about the basis. Look at the bottom here, the volume. This is SOS, sign of strength. There is a big volume coming in here, right? Changing character. This was earlier SOS right here too, with big volume and price moving higher. This is the proper base. So I'll give you later a live example of Bros, because so far it's building one of the cleanest and proper bases I've seen in a long time. All right, so let's move on to a next chart right here. So a few things. So we have 3 uptrends. We have strong uptrend, right? We have less pressure, less selling pressure, less red candles, more green candles, more bullish white bars, and price stays above 21 EMA. Then it's healthy uptrend, which is good. We want to see healthy uptrends, because we can't always have stocks moving higher without any pullbacks, right? That's not good. Eventually, if this is going to happen like this, it's going to dump. You want to see healthy uptrends when stocks go down and undercut 21 EMA, pullback, have a deeper pullback, right? And then you have weak uptrend when stock breaks below 21 EMA. And that's what we're having right now, kind of in many stocks. Stock prices below 21 EMA and even below 50 EMA. So in a weak uptrend, prices usually go even below 200. And once price go below 200, that's actually not an uptrend anymore, right? That's change of character, and we're going into downtrend. And that's what we're having right now. But there's some sort of a change going on in some stocks, and we're going back above 200 and even testing 50s right now. So it's rule of thumb. And here's example name the beautiful uptrend, and there's breakdown below 21, breakdown below 50, that line 50 to 200, right? So there's no uptrend yet. Okay, now we're back above and building a range. And here's back to the uptrend. And back chop, 50. It gives you early entries when it goes back above 50s right here and 21 EMA, right? And this was a big chop here. With an early entry right here over 200 burst, and a pullback, and a beautiful uptrend. All right, so let's talk about supply and demand zones. So this is the same as levels. This is the same as support and demand. Why it's so important to use this as the foundation of your trading? Important important topics I want to discuss here. When we come to supply and demand zone, when price comes to supply and demand zones, how fast does it leave that zone? Do we have a bounce, like one bounce? Do we have a consolidation at supply and demand zone? How long is a consolidation? You have to understand all these things, because faster we leave, faster we bounce of the area, most likely out of the balance is the area, right? If we coming down, price is selling and coming to support, and we're bouncing and forming that spring candle, that means buyers came in aggressively and bought the dip. That means more buyers there than sellers. So so how many times we test the zone is so important, right? More times they trying to test the zone, most likely eventually they're going to break that level. Pay attention if price squeezing or leveling around the zone. Leveling, it's when price hits the same number, like $100, $100, $100, right? There is a limit player sitting there. And squeezing is when we're forming some sort of a wedge. So foundation, again, of supply and demand. Levels are the most important indicator. So levels, it's your price. And it goes left to right from the history, from the past. Price, it's not from left corner to the right corner like some people doing, like it's always horizontal. You can have a little bit earlier entries, cheat sheet entry, right? Cheating entries. But the most strongest is the horizontal levels. So there are historical levels that coming from monthly, weekly, daily chart, and there's like local intraday levels that on the smaller time frames. The intraday levels usually for day trading. And historical levels usually have more strength because there's a backholder, institutional accumulation, distribution. Institutions looking at the weekly, monthly, daily charts. They don't look at the smaller time frames primarily. Smaller time frames is all noise and mainly for day trading. All right, so this is important. Levels. So what forms a level? Trend change. Wide range bar forms a level. Limit players, gaps, and consolidation. We talk about all of them. So the question, are supply and demand zones the same as support? Yes, support and resistance, supply demand is the same, yeah. So the level often, which is support is your level, it's not like exact number, right? It could be when you can have a clean level, price just hits $100, $100. But often it's something between like, 95 to like 102. It's a zone. Yes. So what confirms a level? Multiple touches, like I said before, when price hits the same level. Mirror flip. Mirror flip is when resistance becomes support. So price couldn't break resistance 100, 100, 100, and then breaking, go into 110, and then go back down to 100, and now holding 100. And that's your mirror flip, right? And that confirms 100 is the level. See? Fake breakouts or breakdowns. They usually happen around the key technical levels. There are reasons also behind that, because majority of people putting their stops at the key levels. And institutions know that. And they're gonna take your stop and everybody else stops to build a position. It happens over and over again. Tails, the same directions. You can see sometimes on charts, on a daily or weekly, when tails facing the same direction, and usually there is accumulation or distribution going on. And we'll go over some examples. And trend change, it's same as here, trend change. So the trend is changing, it forms the level. As you can see in this example, let me bring my tool. Where's my stuff? All right, so right here, we came back down. This level, it's a trend change. Let me draw. This level is a trend change. This level is a trend change, right? So in the future, we already know that price, we change the trend, and that's where is a support and resistance, right? As you can see also, we're hitting the same number here. And then coming back and testing these levels right here. Here. So we're getting multiple touches. That confirms your level. So often we have fake breakdowns. So let me show you an example right here. Actually, right here was a fake breakdown. So I'm gonna draw for you something here, right there. On this little candle right there, we're talking about AMD June. So we formed a level when we touched the same price multiple times, but on this day right here, price dropped for 3 days in a row and had an entry, aggressive entry for a gap down and reversal with the fake breakdown below the prior pivot. So here we had a small breakdown as well below the prior lows. But as you can see, these levels, it's not exact like a number sometimes. They're more of a zones, right? All right, so here's a trend change example. Wide range bars. Okay, let's go to this example. Wide range bars form levels, right? Especially with volume. Here's your wide range bar coming here. After that, price coming back down. It dropping exactly to plus minus wide range bar. Here was a wide range bar, and after that we dropping back down and coming back in and testing wide range bar here. Especially wide range bars with volume. That's what forms the level in the future. So limit player, here's an example when price hits the same number. Gaps play a big role. Back to the example of AMD right here. As you can see, you had a gap right there. And price came back down, bounce, and then here even filled the gap. Consolidations form levels by itself. Here's your consolidation, right? We know this trend changed. And this is your level here and here. All right, so let's move to VPA, volume price analysis. Important to know these three laws to know. Supply and demand, it is interaction between buyers and sellers. When price moves higher, supply increases, right? Demand decreases and vice versa. So supply and demand is the most crucial thing in investing and trading. So more buyers, less buyers. You have to read this from the chart and understand the direction. So use important rules like this. Every action produces the reaction, right? So if we're having a wide range bar, we should have a wide range bar in the volume. If we're having big price movement and the volume is small, that's an anomaly. Something is not right. So, and now we're moving to effort and result. So for effort, let's say price moving from 100 to 120 in a week, we should have a big volume there, right? If we're gonna have a low volume for this 20-point move and a big percentage, so something is wrong. Something is not right. There are some rules, I wrote it here. So I'm not gonna go over this. This is pretty simple explanatory. Oh, this is very important. So the first bar gives you a direction if we're talking about a weekly chart. The second bars gives you sentiment, how everybody's looking at it and thinking it's gonna go. And the third bars gives you an expectation. So right here we have a little bit of base, right? First bars gives you direction. Second had a breakup and then doing a pullback, right? This is a daily. On a weekly, it's gonna look a little bit different. But you already have a direction and expectations and sentiment here that we want to go higher. This was an example too, you know, when you had after earnings, big volume. First bar is your directional breakout, then sentiment immediately coming, right? And then expectations, everybody expecting that it's gonna go higher. When you're analyzing candles, it's important to look at the sizes of length of the wicks, ratio between wicks and bodies, sizes of those candles. So as you can see right here, we had really small bodies, not much of price movement. Volume was down. This is called VCP, volatility contraction. Usually it happens before the move starts. The volatility contractions could be long for like weeks and months. They could be small for like 4, 5, 3 days. Right here, this was a volatility contraction. You had 1, 2, 3 days inside of this candle, and you get a breakout, give the gap higher, and move higher, right? So the sizes of the candles, it's so important to understand. As you can see, candles getting bigger, 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 and wick starting forming, right? Sellers coming. Here we didn't have much selling, but strong momentum came, a little bit of selling, strong push higher, continue higher, and then rejection coming in a little bit. Sellers coming. Ratio between wicks and bodies. So how many bodies we have, how many wicks we have. So as you can see right here, once we're coming back to this resistance, we're not only getting, this is not the best example in terms of weeks, but we're getting wide range bars, a lot of emotions coming here, a lot of fake breakouts in terms of one day in multiple days when price can't stay above the prior pivot, above the prior key level. All right, gaps. We're going to talk about some gaps. So exhaustion gap, this is not the best example of exhaustion gap. This would be the better example when the price is extended from moving averages and gapping higher after 1, 2, 3 moves, 1, 2, 3 days moving higher, and there's just no more buyers coming in, less buyers, and everybody using this as an opportunity to lock some gain. And often it forms a really good short setup. So you got power earnings gaps. As you can see, after earnings, the stock gaps higher and advances. You got breakout gaps right here, breaking out over the key resistance and just going into gap and go. We have gap down. As you can see, we're selling down and closing here. Opening here lower than the prior day close and do an immediate retest. So this is overextended gap down. Could be a good entry, but you have to understand this is a good example. Like when you trade in stage 4, this is what you can play on a long side, especially short sellers coming and covering because they're getting really good price move here. You can have a play for like 3 days or so, and then price coming back down. Professional gaps, it's similar to this, and they happening usually at key support and resistance levels. What is a professional gap? It's when price gaps down, closing low the prior day and opening higher the next day. It's a shock value, right? It's some sort of a kicker. And after that, price, as you can see, advance higher. All right, so let's move on. Momentum. So it's important to analyze momentum when we trade. So momentum increasing, decreasing, the angle of the momentum, the slope. What about the thrust, the pullbacks? How deep are those pullbacks? So let's look at all of that. So pay attention to acceleration, deceleration of momentum. As you can see, this is a big acceleration, right? Here was a nice acceleration of momentum. Here is different momentum, right? We slowly moving, consolidation, a little burst, consolidation, burst, pullback slower, and momentum increasing. So why it's so important to understand momentum? It will give you a clue between buyers and sellers. It will give you a clue if buyers stepping in, where they buying. Will give you a clue. The volume will give you a clue as well, right? Because if you see momentum like here, you want to see volume coming in, right? So now to pullbacks. So temporary changes in behavior of a stock. They will give you a clue of imbalance on both sides. And when you look at the pullbacks, because primarily we're supposed to buy only 2 setups. Let's say we trade in stage 2. We buy breakouts, right? And pullbacks. So pullbacks more difficult because sometimes you get a pullback, you buy, but the price in a week later going lower, right? And you gotta get stepped out. So when you analyze the pullback, look at the depth of the pullback. Lower pullbacks, shallow pullback, usually a sign of strength. Look at the proper volume. So let's look at this. As you can see right here, back to this AMD example, we had an initial move and a pullback in 2 days. Immediate bounce, make a new low, bounce back. So this is in front of earnings, a little bit different story, right? Probably the best example would be back here, actually. So so we're going to talk about depth of the pullback. How deep is a pullback? So you have to understand, first of all, how big was the leg up, right? And how deep was the pullback. In this example right here, we were so extended. So you can expect a deep pullback. I usually don't use the percentages like Fibonacci levels and stuff like that. You can just use the common sense. When you're getting a big move like this, you will get some sellers. You will get a lot of sellers coming and taking the profit, right? That's why you're getting this selling back. And the depth of the pullback is so important. As you can see from this move, the pullback was 50%, right? From high to the low to 50%. And it started to hold here. So the volume, you really want to see the volume decreasing on a pullback. Again, this was a good example. You see the volume increasing, breakout, and then on the pullback, we don't have any sellers coming in here. A lot of yellow bars. Making new low here on a lower volume. Here as well, as you can see, we're getting a little lower volume here. This is a really good sign of accumulation, less selling coming in, more buying actually coming, supporting this level. All right, so let's put it all together. Look at the STX example. Draw for you. Do you have any questions at this moment? All right, so STX, we had a really nice breakout right here. This was our stage 2 breakout. And now stock is advancing from here. It's in stage 2, right? So, and it's been consolidating for approximately 2 months, April to October, right here, April to October. Moving averages on a weekly chart is going flat. So we're having a low here. This was our spring candle. We're having a low. We have a trend line. We see that the price on a bigger time frame, on a weekly, where are we going? We're going up, right? So we went up, we went, and doing a pullback, we went lower a little bit. So how can you plan this to buy in this area? Like I said, first of all, you have to understand that we're in a stage 2, check. So what are we looking for right now? We're looking for a proper setup for the pullback, for the breakout of this decline, right? In a small time frame on a daily. So we had earnings right here. We had earnings. You waited for earnings, and we had a setup here on a daily. As you can see, the volume increased right here, and you got a little bit of VCP pattern right here. VCP after earnings with the gap higher, and that was a perfect entry to go long, build a position above the moving averages. So what else you see here in this area? You see that we having 200-day moving average there, and we holding 200. Also, we have all moving averages flat and slightly pointing higher. We also having right here moving averages cross, and this is going to be our coil pattern. Wedge pop, sometimes people call it pop over the moving averages. So as you can see, all of these moving averages right here, they're forming a wedge, you see? This is kind of a wedge between moving averages. That's how you find this stock, but you don't buy before the earnings, right? We don't know what earnings gonna give us. The technical setup here on a daily and a weekly is long. You wait for the earnings and you wait for the signal. What is your signal? The reaction after earnings, the first day, gap and go, and then you can establish small position on that gap and go day, which is right here. Or you could wait for that VCP little flag setup and play the breakout right here on this day. And then you got a moving average uptrend. Where would you take your profit? We have a level right here, right? Where would put you a stop? Well, stop would go below your moving averages or below your gap right there, 21 EMA. The entry would be right here, and you would get really good profit towards this area. You could leave some to play because we don't know where we heading, but I want to point you something here. It's important to understand that probably you should take most of your profit on that candle, on that extended candle. Why? Look at the volume. It gives you an earlier clue. Price gives you a clue, volume gives you a clue. You see the decline in volume, price advancing, and we're getting a decline. There's less participation. We want to see more participation, right? What else? You don't want to see price moving like this in 2 weeks. Because when we're going to take elevator up, we're eventually going to take elevator down. It happens all the time. So we have to see proper price action. And that's what happened here. We had a few days right here. We had 2 days going down, right? So, but then here's the analysis of your pullback. Remember we talked about pullback, the depth of the pullback, how we balancing, what is the volume. As you can see, the volume was declining right here on the pullback. We bounced off 21, came back and tested this area. So we have a level here. We're building high low here. It gives you a clue. The weekly, especially forming another potential breakout higher. What does the volume tells you? It's slightly increasing on the way up. So you got a little bit of sellers coming in here. And then again, lower volume decline. Coming back higher. Volume increasing. Question. Looking at the charts, you have multiple areas of dashed lines marked. Sure. Does it help us understand if we take an entry that we could expect resistance as we look at to come up to each one? You can take targets, sure, at some of these areas. So as you can see, this line support, this was our resistance. This is your big channel. This is a potential stage to continuation, right? This dashed line, it's also important key level on the weekly, because from here, remember we already talked about what kind of level is this? Lower high, trend change, right? So if I'll draw for you here, So the trend came to this area and then it changed down, right? So this was a trend change. So, and of course, this would be a good area for you to play earlier, right here on this candle, and then hitting on this pivot point or taking profits. It depends how you manage your position, right? Sometimes people go all in, sometimes people go in small portions. So I would go in small portions because we don't know exactly if it's going to break or not. Also, here's something I didn't mention. What is this? This is wedge, right? What is this? A trend line. You get a trend line break right here, right? Trend line break. When you line up everything together like this, in this example, STX, and you also get good earnings, right? And the volume increasing. You get one of the best plays, and here you go. The move was 85 to 120 almost. In terms of percentages, was really good, and it happened only like 1, 2, 3 weeks. 3 weeks. All right, so for the playbooks, developing a playbook. When you develop your playbook, you have to refer to the most important foundational, it's the foundation we just discussed. What is that? Support, resistance, levels, misspell there. So support, resistance, levels, the price action, volume. So what is a playbook? It's a book of strategies. You have to make it simple. We talk about the edge with live fire another day. What is the edge? It's the playbook defines your edge, right? It's a unique approach, but you have to use this as your unique approach: price and volume, because those are the most important indicators, right? Price defines support, resistance, price defines levels. The rest is secondary. So when you build your playbook and system, you have to use this foundational approach. And the edge is honestly, it shouldn't be like I'm using Fibonacci, I'm using RSI and MACD in combination and something else. This is going to be way more complicated, and it's not even going to work because everything else comes from the price. You know, the price is the most important indicator because it's true. It's happening right now. The rest is derivative of the price. So back in like 1900, how did they trade stocks, right? How did they buy? They only had price. They didn't have charts. They didn't have anything. They only used the price. They didn't have volume. Then the volume came, right? They started using volume and looking at how many orders coming in. And then everything else started coming, right? All these moving averages, and it's like whatever, 70s, 60s, 80s. That's when it started doing it. Why would you focus on something else? Focus on understanding price and volume. So when you build your playbook, that should be your foundation. And that should be your edge. So when you build your playbook, I just discussed two important playbooks. I think one of the most important you probably can be involved. It's a breakout and pullback. Breakout and pullback, right? And we already know that we should be involved in stage 2. Why we should be involved trading in stage 2? kind of going back. Because price tells you so, isn't it? The price tells you that institutions buying. Volume tells you institutions coming, confirmation. What else do we need? Do we need some voodoo indicator showing us? What else do we need? We need foundations, right? We need, fundamentals. Earnings, show me good earnings, right? Show me good sales. And when the market is strong and sector is strong, it's even better. So what are the characteristics of a really good playbook? You need a strong market, strong sector. You need those great earnings, great sales, and you need a leading group, right? Setup. So this is kind of like a checklist, but there could be exception. So right now, market is not good, right? We don't know exactly if we made a low, or we're gonna continue going lower, right? Usually 3 out of 4 stocks moving direction with the market, but there could be an exception. So even in a bad market, if the stock has part of the strong sector and has great earnings, great sales, leading group, and has a setup and proper VPA, even in a weak market, it could be a good idea, right, to trade. So do you have any questions at this moment? We talk about strong market, uptrending, right? What is a strong market? When we have a lot of clean looking charts. We don't have any overhead resistance. Prices staying above 250. We have new highs, more new highs than new lows forming in the market. What is a clean chart? Same characteristics above the moving averages. And when the price behaves rational, right? We don't have those crazy days and choppiness like we've been having in January. That was nuts. When we're moving up for a few days and then we're moving down, making new low, and then we're making new high. It's chop. It's called whipsaw action. It gives you a signal, stay away. Stay away from the market, because market doesn't know which direction it wants to go, or they know and they're just cutting everybody, taking stops right and left. All right, so question. Yes, is there a way to determine the strength of the market? Would it be tracking top 10? No, you can look at simple indices. You can look at simple indices like SPY. What do you see here on SPY right now? CP 500, that we broke the trend line, moving average is pointing down. Big volume on a breakdown, we below the moving averages. On a weekly, we in uptrend, right? On a weekly from 2020, we in uptrend. But this is the first sign that we're breaking moving averages. So there's some change. Can it be something like this, which is going to build a big consolidation? Yes, it could be. Maybe we're going to go back here and we're going to go back down here. It takes time to build a consolidation, right? But you already understand that there is a change in direction, change in character. On a smaller time frame, you can look at this and see on a daily, right? Go back to weekly real quick. Here you can see that this week broke above the prior week. We had a big volume, and on this week we didn't make a new low. That's a good sign, but we rejected here the moving averages at the prior wide range bar. which is the approximate level right now, right here. From here, it's approximate level. So we're having this channel right now. And then on a daily, you have a moving average here. But there is a possibility that we're building high and low right here, and from here, go back. Possibly, idea that we're gonna go back here and maybe do something like here and go higher. What else it could be? And maybe we come here, and from here, we're just gonna go back lower to this level. So you don't have to track top 10 names, but there is definitely a way of doing it, right? You can track big names like Tesla, Amazon, see how they're behaving. You see many stocks below important key moving averages, many stocks in downtrend, Facebook breaking down. It gives you a clue. And new highs and new lows. Yep, new highs and new lows. New 52-week high, new 52-week low. You can go to Finviz, and you can see new 50-week high, new 50-week low. You can also go to right here, certain indicators. See an example. Stocks below 50. As you can see, we just had a bounce because we were oversold, but we are pretty low. We have 40% below 50. 100 is also looking weak. 200 looking real weak, making new low. So we really, as you can see, going in decline from 2021 stocks in decline of 200-day moving average. You see the point here? Here is also on a 100-day moving average. And the 50 is in the consolidation, right? This is the big indicator showing sign of weakness. All right, so back to this real quick. What is a proper VPA? So volume price analysis. Ask yourself important questions when you're analyzing these setups. How is the price looking? How did it close? Did it build some sort of a volatility contraction? Did we do a retest, closes retest? So we went to support, bounce of support. Maybe we went to support, consolidated, and had a shakedown, fake breakdown, right? Did we have a shakedown both directions? Why it's so important? Have a shakedown. That's how they're collecting stops. That's how they're building a position. Who they? Institutions, right? What kind of pullbacks we have? Shallow, deep, momentum increasing or decreasing? What is our trend? And you have to have proper volume signals, right? Like low volume on a pullback, high volume on uptrend. Some examples of good fundamentals. Again, to this AMD, I think this is all explanatory, as you have to look at some increase. As you can see, earnings per share, year-over-year growth, big change fundamentally, right, for the company. As you can see, 2019, 2020, 2018. We started 2019, very nice uptrend on AMD, pretty much $20 to 160 because of the internals, foundations. When I started trading back like 5-6 years ago, I didn't even look at foundation. I'm like, well, price makes sense. Yes, price pays, price action and volume, the most important stuff for you to analyze. But you have to cut it the rest of the stocks. Most of the time, you have to cut them and focus only on stuff that has really good internals, right? So scanning and building a watch list. There are a few scans I can share here. Some from TOS, stock breaking over the 50 MA. There's some fundamental scan. This is something I'm looking. You can play around. I have about 5 or 6 different scans. I'll show you in a second. You see playing with different earnings per share, sales, stuff like that. You can play with price being over the moving averages. So when the market changes, so this updates every day. You'll see also, this is your contrarian indicator. When you scan every day, sometimes you can see like only 1 page. Sometimes it's 5 pages. Why is this 5 pages? Because stocks price is staying over the moving averages. This gives you a sign this market is strong, right? So when the market is strong, this is something you can do it. Now you have 5 pages. How can you find the best stock to trade? Well, you can actually raise your numbers. Instead of 30% earnings per share and sales, 30%, you can ramp it up to 40%. So it will drop your list down to the best companies for you to focus, right? So when you also look at the stocks, you have to look at relative strength zones, RS. So stock has to perform better than the index, better than the market, right? Let's look at example of Bros. So you can see market declining. There's no line actually. It's not the best example here. All right, I'll show you 1 second. Focus list, CF. As you can see, market started to decline right here, going down. This purple lines, this is S&P 500, right? It's going down. On this day, market going down. On this day, market going down, and CF is also sold, right? Selling on this day, market going down, CF hitting the bottom. Do you see this? On this day, market going down, CF is going higher. This is the strength. They buying CF. You see this? Market still going down. Market going sideways, CF going higher. This is your signal that there is a relative strength. This is one of the indicators you have to use as well. As you can see, we bought here and we bought here. This is a stage 2 weekly in a stage 2 uptrend, right? But this is not a first base. You have to understand that it's a little bit difficult. This base 1, and we had advance. So your base 2, and now we have an advance, wide range bar. So possibly this is the base 3 forming. So, but it's okay. We can play. We can play on a swing side for a week or multiple days, right? It doesn't have to be for a month or something to hold a position. So as you can see here, you got a wedge pop over the moving averages. We made a new low right here on this day, but the volume was lower, and we immediately pop. That was the first signal of the fake breakdown below this pivot. And of course, relative strength is strong. Pop over the 50-day moving average and pop over 8 and 21 with the volume and close there. Then you have a trend line, break of the trend line. This day was the first long. Where will we put you to stop? Right here at this level. Let's look at hourly chart. As you can see, you get a nice breakout here. You would buy here. You would put your stop below this candle. Yes, you had a shakedown. This is ugly, right? You get a shakedown because market is volatile. You have to understand market is volatile and this instrument is volatile too, right? It likes to move in big waves. These days could be really wild. But you have to have rules. If you bought here candle over candle, this was your entry. Why this was your entry? This was the pivot point. What are we talking about here? Trend change. From this candle, trend change down. We came back immediately. The pullback was tiny and it was a fake breakdown. Volume came. Look at the volume. Look at the volume here. We bought here. The next day, you could buy more. On a breakout over this area, buy more, right? Now stop from here. You move your stop right here. It's above the moving average, 50. Price consolidated. Inside day, inside of this, right? Inside day, what do you see here? Volume decreasing. What do you see here? Remember we talked about gaps? Price closing here, gapping up higher. This could be another buy. First buy, second buy, third buy. This was also pivot point, wire range bar. Look at the volume here, right? This is a significant level. From here, we had a breakdown, and now we came back and testing this level, rejecting here. Look at this. We just talked about levels. That's how you analyze this stuff, right? If you didn't take a trade here, you could take a trade right here. If you just do your homework, analyzing this levels and understand the price action, right? And you would be prepared and have this stock on your watch list on what setup? Stage 2 pullback, right? With potential breakout. Now, what it's doing here? It's doing a pullback. How deep is the pullback here? We don't even touch moving averages. Look at this. The pullback is really shallow. It doesn't even pull back to 70s. And it closed back at the key level. There's a lot of strength. Less selling. Look at what market did. On this day, market went down and made a new low. We're closing on a high. This is your relative strength. Most likely, yes, earnings coming. We know that. Most likely, they want to run into the earnings. And we know this is a very strong sector, CF, materials. All right, question. When evaluating sales, revenue, EPS across quarters, once earnings are released, typically how long will it take a large institutional investor to buy into the position? Well, they can't buy in one day because they often buy big positions. It takes for them weeks and even months to build a position, right? Often when earnings release, it's already priced in. Stock price run into the earnings. So when we see this power earnings gaps, that's a surprise element. Nobody expected. Company did better, right? You're talking about Facebook. Nobody expected this, right? Company did really bad. Nobody expected those numbers. Yeah, earnings per share higher, but I think they had a really low amount of people participating or something like that. So nobody expected that factor. And stock is already did gap down here, many gap downs. And stock is already in decline, right? There's something wrong with this name. As you can see, earnings per share stalled. 388, 330, 361. We're not going anywhere. 322. So we're still there. We're not going anywhere yet. So they got to do some change here. And back to your question, you mentioned they try to anticipate earnings early. So we will see indications. Yes, price. You see the price declining. They're anticipating that earnings going to be trash or something like that. Tesla. Tesla is a good example. You see this earnings came out here. They were anticipating. Here's your setup. You got base breakout after earnings and anticipation running into this earnings. Earnings came out, great earnings, price dumping. Why? Because price already went enough and it's overextended and it's already priced in at this level. This isn't a rear mirror, right? It's irrelevant unless they give you a surprise on earnings call. Back to your question. For example, why did the large investors not anticipated removing their positions from Facebook before earnings that resulted in a large drop in price share of the... All right, so we don't know exactly, right? So large investors may be sitting from this area. Everybody's doing, their own evaluations. Everybody's right and wrong only like most people right only like 50% of the time or even less. So including institutions, including hedge funds and all of them, right? By the way, earnings were great. Numbers, I think, is great. They just had some negative things going on with the company. And I don't know why some of them, people are stubborn often, right? You should not listen to anyone. You should listen to price. What do you see here on the price action? It's a down move. It had a lot of gap downs, a lot of distribution. The smart investors are already getting it, that it's not a good play. The stubborn ones got smoked here, whoever decided to play this for the earnings play. Let's look at the relative strength here real quick. Look at the market going up. This one's going down. See, market going up, this one's going down. There's low relative strength. Now it's 1. It's like after this dump. All right, we are going to be finishing a few more things here. The price action we already talked about. VCP, price shakes both directions, stuff like that. Important questions to ask, right? If you have any questions about these points, let me know. But this is pretty much a checklist you have to use before you're building a position, before you finding a stock, right, to trade. Here's some examples, playbooks. As you can see, this is a daily setup, daily setups, right? But what are we doing here? We're playing this in stage 2, like here, Tesla. It's a stage 2 play, but you're getting these little setups, right, of the daily. Daily gives you an entry, gives you some ideas to trade. So risk management, very important. So we're probably going to talk about this some different time. We're already having a long conversation, like 1.5 hours. So I'll pause here and we'll discuss probably next week. Do you have any questions right now about what we discussed? Could you show or talk more about how you evaluate a 5-to-1 reward to risk, or cover next time? Yeah, let's do it now real quick. So ideally you want to have stocks that have room to run, right? Let's talk about example on Bros, the stock I just traded and I'm actually in still. Great example. As you can see, it's not drawing the relative strength line here, but it's 55 and it's pointing higher while the market is going down. So in this example, our prior resistance, so we're having a level right here, right? This was a level. From this, we went down, made new low. From this pivot point, we made down, made new low. So I was trading right here. So my first target was right here. So entries were right here in this range. If you stop below this day, and my idea is to get at least target right here or higher. So the average, I believe, was somewhere around 50. So I'm aiming for about 2R at least to make here. But here is a bigger picture, right? You look at the weekly chart. This was a pivot point. If we're gonna pass this pivot point, so we're having a lot of strength, and you really have to believe in the stock. This is another point. So this was our prior big weekly level. If I buy here and everything's gonna work, and this is gonna be my target, so it's pretty good return. So risking, let's say 8%, return, let's say 50%. This is pretty good return, more than 5R, right? And that's how you look at it. On a weekly chart, you buy here, weekly candle breakout. Let's say you're conservative. Your stop is right here. Your entry right here. Your risk is 21%. Your return is 63%. This is 1, 2, 3, right? This is minimum what you can get. But you have to understand that you have to play this weekly play, right? Weekly chart. So what I did, I'll show you my trade actually. Let's see. Let me show this one. All right, so what I did, I played the pullback. That was the initial move. I added on a pullback, 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 and then we have a push, and I'm selling. Idea was to hold this. The reason I got out completely because Starbucks reported. You have to also look at other factors, right? Like this is a coffee company. What other strong names in the same area? We have Starbucks pretty much, right? The leading dog in this sector. So Starbucks reported earnings and reaction was really poor, and I didn't like it. And I saw it after hours some, and right at the open I get out. But what reaction do we get after on Bros? There's no selling. So I went back in, and I'm looking actually go back in more, go back to my full position on a breakout here, and probably breakout higher of this 62 eventually. So we have an uptrend here above the moving averages. Look at the volume. This is the proper volume. What do we have here? Stage 2 breakout. Why did I enter here early? This was a cheap entry before breaking this level. But because it has a fake breakdown here and a massive volume and a strong relative strength, and you had a wedge pop between moving averages, you have to anticipate sometimes. only when it has proper signals in terms of volume and price, right? So you got really nice bounce here, volume, spring candle, wedge breakdown, right? This is the wedge breakdown, and building high low setup right here. Did I answer your question about the 5-to-1? So based on the time frame you play, you have to have room to run, and you have to anticipate the stock actually has what it takes to give you like at least like 3R, 4R, 5R. All right, guys, good class, 1.5 hours. So we'll continue. We'll do probably next week or something like that. We'll cover risk management, trade management, and stuff like that. All right, if you have any questions, let me know. Other than that, take care. I'll see you later.